everybody to the inaugural episode of the We Them Brothers podcast. I'm one of the hosts. My name is Jimmy Hicks.
And I'm Anthony Rogerson. I am the host. This is my co-host, my sidekick. I'm the star.
We already starting out the gate.
Let's get it straight. I am the star of the show. Okay,
I look mad at it.
No.
I'm the assist man. I'm gonna throw it out the backboard for him. So.
No. Welcome, as Jimmy says. I'm Anthony Rogerson. I am one of the hosts of the We Them Brothers podcast, and this is Jimmy Hicks, as he said.
Yes, episode number 1. And I guess we'll give like a little backstory or what we're trying to accomplish with this podcast. We really just want to give. Of course, it's going to be an opportunity for us to just shoot the shit about anything, not just mortgages, but. We also want to give a platform to other real estate professionals, real estate agents, insurance agents, closing attorneys, inspectors, whatever the case may be, to pretty much showcase what they bring to the table as far as the real estate industry and to get their ideas on a couple other like hot button topics in pop culture.
Yeah. So as I said, I'm the star of the show. We're not
gonna get that twisted.
Everybody got to have a star. I've been wanting to be a star my whole life. Here I am now in my later years, and I'm the star. Quiet on the set, please. So it's just all jokes aside. Jimmy and I got together to create this platform, and as Jimmy said, to provide a space for other real estate professionals to showcase your talents. And really show the world and tell the world why they should use you. Why should they use your business? Why should you be their realtor? Why should you be their inspector or whatever your business is? So we just created this, and we're gonna talk about some things. Jimmy and I are both finance professionals and experts with roughly 35 years collectively
between the two of us.
Between the two of us, collectively experience in the industry. So we'll talk some things about loans. We'll talk some things about mortgages. We'll talk some things about real estate, and we'll just go from there. So we thank you all for joining us, and we're here to have a good time.
Absolutely. So we actually wanted to start off the podcast with probably the question that we get asked the most, and that is like pretty much just tell me about the loan process from start to finish. We know, of course, we run into it all the time. Like a lot of people are apprehensive about getting their credit scores. A lot of taboo, false narratives about like just getting your credit checked or getting your credit pulled. So like there's a lot of, I guess, fear, for lack of a better term, doing that. But that's one of the goals from this podcast is to make sure that we're educating the masses as to the home buying process in general. So this is like pretty much from A to Z as far as what to expect when you get ready to buy a home.
So what would you say if you were talking? Let me hold on. I'm sorry. I am the star of the show. I got to keep saying this because he's the director and editor. He might try. I'm trying to say it enough so he can't edit it out. So he can't edit it out. I am the star of the show, of today's show. Anyway,
put it like this: he's David Ruffin, and I'm the Temptations. All right. But I understand nobody come to see you else. But ain't nobody come to see me.
But no, in all seriousness, so if someone, we get this all the time. So if we're walking someone through it and you talk about, you'll give a consultation and someone will ask you some questions and all. And at the end of the consultation and they're ready to move forward, one of the things that they say is, well, do you have to pull my credit?
Right.
What do you?
Very first question.
So talk about that. Talk about the application part of it and what goes. Just tell the people the application process.
Right. So the very first thing, one of the first things is getting your credit pulled through the application process. The application is where you pretty much fill out everything. You get your name, date of birth, income information, asset documentation, like as far as like what's in your bank account, whether you have saved up currently for the home. We get all that information. And we pretty much determine from there what you can qualify for, what program would best suit you, your interest rate, pretty much everything starting out of the gate, like what to expect as far as like what program you're trying to qualify for. So as far as the credit is concerned, and we'll delve into this more, I like to personally, I don't know how you explain it to your customers, but I like to explain it to where the loan process is pretty much like a three-legged stool. And those three legs, you need all three legs working in order to prop yourself up and properly get a loan. So those three legs, in my opinion, would be credit, income, and assets.
Let's repeat that. Credit, income, and assets.
Yes.
Credit, income, and assets. Those are the main three components in going into your qualifications. Go
Absolutely.
ahead.
So let's talk about credit, since that's the first thing that usually people ask us, like, do I have to get my credit pulled? Is it going to be a hard pull versus a soft pull? Now, I would like to let you know, like, we here do have the capability to do a soft pull. But as far as the application process is concerned, we would eventually have to do a hard pull anyway. Now, a hard pull or just getting your credit pulled once, I mean, let's dispel the taboo myth now. Getting your credit pulled once does not drop your credit score.
Yes, it do.
Yes, no, it don't.
Yes, it do. Yes, it do.
No, it don't.
My aunt told me when they pulled her credit for her car, it pulled down her score.
Her score went down 40 points. These are real conversations that we have. This is not just us like...
This is not a parody.
This is like verbatim. These are conversations that
verbatim, i.e. the do, not the does. But
now, I guess I'm jumping back just a little bit, because a lot of people, those who are monitoring their credit, are probably monitoring on a platform like CreditWise, Credit Karma, even maybe like straight from Experian or TransUnion websites. Just so you know, those scores are not necessarily wrong, but they probably won't be what we pull for a mortgage.
They are not accurate scores. They are scores that are used as a range to give us a range of where you are. Are you in what bucket are you in? Are you in the 800 score bucket? Are you in the 700 score bucket? Are you in the 600 score bucket? It just gives us a gauge of what we're working with. So it's never going to be to the point, or to say if we're using money, it's never going to be to the penny. Okay, so it's just going to give us a range of where we are. So I'm sorry. Go ahead.
No, you're fine. So basically, saying when you're applying for a mortgage, you're going to get a different version of your credit as opposed to applying for an auto loan or a credit card or a department store credit card, personal loan, whatever the case is. So when we pull the score and you get something different than what you've been seeing on your app, doesn't mean anybody's lying to you. It just means that things are weighted differently on your credit report. So that credit card payment that you made that was on time and you kept your balance low and everything, probably going to be weighted more to us as opposed to like if you go to CarMax and get an auto loan through them. So as far as getting your credit, like jumping back to where we were, as far as getting your credit pulled, you don't have to worry about getting your credit pulled to go through a home loan and then dropping your score. That's not what happens. Now, if you're getting your credit pulled several times in a short time span, like if you come to us and you get your credit pulled and then you go apply for an auto loan over the weekend and then Macy's saying they're having some kind of sale, so you apply for their credit card, all that in a short time span, that will drop your credit score. So applying for different versions of credit will drop your credit score. You should be able to apply for at least 2 or 3 different mortgage companies within a month time span without it affecting your credit, because the bureaus want you to do that just to shop around for the best interest rates and best pricing or whatnot.
Okay, so once we've pulled the credit, or once you've pulled the credit, I guess we will highlight what we look at when we pull your credit. Okay, so there's also a misnomer, right? Someone often says, or people often say, well, I have a $60,000 on my credit card. That might be an exaggeration, but depending on who it is, it might not be. They often talk about the balances that they have on their credit, right?
Right.
We're not concerned, for the purposes of home loans, we're not concerned what your balance is, okay?
Correct.
We are only concerned on what your monthly payment is. So let's just say you have a balance of that $60,000 on your Macy's card, and your payment is $2 a month on that card. We're only concerned with the $2, not the balance, okay?
Well, one of my concerns would be what the hell you're buying at Macy's if you have a $60,000 limit with them.
They had a sale. What you mean what I'm buying?
60,000?
Yeah, they had to get the sheets, the 600 thread, 800, whatever thread sheets.
The Polo, the Ralph Lauren joints?
Yeah, okay. Chanel.
All right, that adds up.
The threads.
That adds up. Up.
I don't care. He's digressed. I don't care about what you're buying at Macy's as long as we can help you get your house. Okay, so that's, again, when we talk about your credit, we're not concerned with the debt. We're not concerned with the balance. We are concerned with your monthly payments. Okay, so we look at that.
Yes.
There's a few things that talk about a little bit. Tell people about medical collections, because oftentimes
Right.
people are concerned with medical collections. How do we as lenders feel about medical collections?
So we don't actually care about your medical collections.
What you mean? I don't care. They keep sending me letters. I gotta pay these medical bills off before I buy a house, don't I?
I guess let me rephrase. Medical collections, or especially new medical collections, will drop your score just like any other collection.
Gotcha.
Now, as far as the debts that we have to count against you, because the debt to income ratio, which we'll get into a little bit in a minute, but that's how we determine how much you can qualify for. Like your credit score is going to determine if we can qualify you and what programs we can qualify you for. The income is going to determine how much we can qualify you for.
So if I'm getting this correctly, we don't care about the medical collection. The only way that the medical collections hurt someone is that it could be potentially weighing down their score.
Correct.
If it's new medical collections. Okay, so that's important
Absolutely.
it's important for you all to really understand that concept. Please do not. Well, I guess I shouldn't say. Yeah, I'm gonna say some stuff. Once you get to know and become a friend of the podcast,
we'll get it in post.
There's going to be a lot of things I probably should. Don't go out there and pay them medical collections. Just go ahead on and get your house. We do not care about the medical collections. Okay, we can edit that if we need to edit that. But
if we get in trouble with legal, then
that's a whole other story. So so we talked about credit. I'll talk a little bit about income.
Yes.
Okay. So your income.
So if I
hold on, I'm the star of the show, bro. Don't be.
I was trying. This is my time to throw it up and then do like this, the Dwayne Wade, let's use LeBron James.
I don't need all that. I don't need all that. I'm
all right, ISO Joe, go ahead.
I'm a goddamn star in these streets. Next time you cut me off, you will be off this platform.
You see you waving off the pig.
Okay.
You see,
listen.
America, you see you waving.
We
off
have
the
a new name of the show. The show is now singular. I'm that brother. We, the brothers, have been canceled. It was the goddamn first episode. He gotta go. He gotta go. It's just no. Let me move the mic over. But no. So go ahead.
We waving away pigs. But no, like all right. So this is a question that, of course, we get all the time. Like, I make X amount of dollars. How much can I qualify for?
Great.
And I'm assuming that you're gonna get into it, like self-employed versus W-2 income, other incomes that we can count.
There's a difference?
Big difference.
Oh, I might want to learn that. So I can learn this alone.
There's a big difference. Well, I'll let you delve into that.
So that's a great point. So we all often get, I make $50,000 a year. How much can I qualify for? How much of a home can I qualify for at making $50,000 a year? I will sum that up by saying this. It isn't what you make, it's what you spend. Okay, or what you already owe. Okay, so you'll have two people, Miss Jones A and Miss Jones B. Miss Jones, they both make $50,000 a year. But Miss Jones A, she doesn't have existing debt already. So she doesn't have a car note. She doesn't have that $60,000 Macy's bill that we talked about. Mm-hmm. She doesn't have any type of student loans. So she doesn't have debt already. Okay, so Miss Jones B, who makes that same $50,000, she has a $1,000 car note. She has the Macy's credit card bill. She has student loans. So she already has existing obligations. So if we compare them side by side, where they're both making the same $50,000, and they may even be coworkers, right? Because what happens sometimes? You get a call, you help someone get a house, and they say, "Well, you helped my coworker get a house." Right, and you got her qualified.
You got her qualified for down payments.
You shouldn't mock people like that. Somebody might get offended. We have a broad audience. That's why I'm the star, because I know not to do this type of stuff. Right? Shit, he doing
a different voice.
It's very stereotypical.
That was offensive.
You could offend some
people.
That
was definitely a real.
Speaking of offending some people, we're probably gonna offend some people on this show. And sorry, but so
based on society, like this is how we get views. By offending people. I think if we were just nice.
We're going to politely offend people. Respectfully. We'll spell that later. But so oftentimes we get coworkers. You help my coworker buy a house. We work in the same department, and you helped him or her qualify for a $400,000 house, and we make the same amount of income.
Right. That
person assumes because we helped the coworker to get approved for that $400,000 house, that they're going to get approved for that $400,000 house. But when you think of your credit report, I want you to think of it's your report card. It's your financial report card. Everyone's report card is not the same. Okay, so you may get a different reading or you may get a different qualification based on what your financial report card states. Okay, so it's very important to, again, use your friends and your family who have purchased homes as some type of guide, but just simply because they were able to do X, that doesn't mean that you're going to be able to do X, even if you believe your financial circumstances are pretty similar. Because people only really tell you what they want you to know. So there's always something in there, a nuance or a curve to some capacity that you don't know about that makes your circumstances a bit different. So
they may not have told you that they paid all of their bills off before they got that $400,000 house because that was the only way they could qualify for that $400,000 house.
Right. So income is very important, but it's also a relative, or it's just a relative subject, right? So you make $50,000, but your existing debt is what, right? Someone that makes 50 and has no existing debt is going to qualify for more than someone who makes 50 and has a ton of existing debt. So, and that's very important to talk about income. So let's kind of transition into, we got the application, we got the credit, we got the debt, we got the income. We have the application. Talk to them about what happens at that point after you've kind of looked at all of those things. If you want to talk about their approval or approval, pre-qualification, into pre-approval, kind of speak to those points.
Great segue. This is why you to start, because this is a great segue.
Because I'm a star, because I know shit. That's why I'm a star.
Second question that we get most often: pre-qual versus pre-approval.
Is there a difference?
There's absolutely.
You sure? I ain't speak on it. Tell the people. I would tell y'all, but I'm gonna just sit back and be the star right now. This how stars.
So here's the difference. I'm gonna play what Russell Westbrook should be doing, coming in with the second group and balling.
And that's the implementation of the pop culture right there.
Right. There you go. See?
In sports.
That's what I'm saying. So pre-qual versus pre-approval. Pre-qualification means pretty much just that. Like, this is based off of what we're seeing in the system right now, without going through underwriting or anything. This is what we can qualify you for. So the next step after the application, after we get your credit pulled, we get all of your information on the application, is to send in the dreaded documents, all the paperwork, all the trees that we like to kill in the mortgage industry. Well, everything's electronic now. So.
Everything is electronic.
But I digress. Pay stubs and W-2s, of course, the most important thing. Like income docs in general, I would say the most important thing starting out, because your income, your monthly income versus your monthly debt is how we're going to determine what you qualify for or how much you can qualify for. And jumping back to W-2 and self-employed bars, the way or the documentation that we ask for and the way that we can count that income may be different. We're not going to give you everything because we want to have multiple episodes, so we're going to save some topics for later.
And we want you to call us too. So if we told you everything right now, you may take this information and go down the street to your cousin that's a lender and use our information against us.
Yeah.
So you can't.
The money's not in the cure. The money's in the medicine.
The money is in the. We're like your mechanic. We're gonna fix your car.
I'm gonna take your oil, but I'm gonna take a spark plug.
Good enough to get you down the street.
Right, you coming back.
We're gonna get you down the street, but you're not gonna get over the bridge. You gotta come back and see us either way. But no, go ahead.
But no. So as far as the income documents, let's just go straight forward. W-2. If you're a W-2 employee, then really all we need is your last 30 days of pay stubs and your last 2 years of W-2s. So this is 2021. We would get 2019 and 2020 W-2s from you. We calculate, hopefully you're either a salary employee or you work 40 hours a week religiously. That's easier to calculate. Obviously, like if you work part-time or if you work offset hours, all my trucker friends, if you get paid by the mile, like your income is going to be calculated a little bit different.
We can still do it. It's just not. It's just not as black and white as someone who makes, again, $50,000 a year, or someone who makes $20 an hour and works 40 hours a week. That's a very simple calculations. But we do a lot of unique things for our exotic employees as well. And when I say exotic, we also have stripper loans. Well, no, that's wrong. You just cut that out. Just Just chop
I'm
that.
not.
Right?
No, I'm not cutting that out.
Chop.
Because technically, we do have stripper loans.
We do have stripper loans.
Because if you're a stripper and you're properly filing your taxes, we can help.
I'm starting to go to Hollywood. I don't want to talk about all that type of stuff. So go ahead, Mr. Hicks.
I'm just trying not to discriminate. All facets, like we help everybody.
All right.
So
facets, you said
facets. You're
very intelligent. I thought he
facets.
said
All facets.
Do
Let
your
me get that right out. All facets.
That
Let me
sounds
get that
like
right on the
facts.
No. Already. We'll get it in post.
You go.
But yeah, so let's just go with a straightforward bar. Let's say that you work salary, and you get $50,000 a year. That's basically what we're going to calculate. 50,000 divided by 12. That's going to be your monthly income versus whatever your monthly debt is. And then we would take that percentage. Now, depending on the loan program, that's going to determine what percentage of your monthly income can go towards both your monthly debt and the new housing payment. So we have to keep you under a certain threshold for most programs. So let's say, for example, FHA, we can go all the way up to 56.9%, depending on your credit score. So let's say $50,000, and you guys can do the math at home, divided by 12, whatever 56.9% of that monthly income is, that's how much you can qualify for based on your debt that's on your credit report and the monthly payment for the new home that you're buying. So I would say that goes back to the conversation that you were saying, like the two people working at the same job, both making $50,000 a year. One has just the car loan and a small credit card. One has a bunch of student loans and other personal loans and stuff. These same two people are going to qualify for a different amount based off of that calculation.
Got you. So in talking about that, and talking about, Jimmy mentioned the pre-approval, the pre-qualification versus the pre-approval.
Yes.
Okay, so it's very important in understanding the two. When you submit your application, you're going to fill out all the information as you know it to be. Okay, and we're going to give your agent and yourself somewhat of a verbal pre-qualification, right? We don't necessarily send out pre-qualifications because they're not worth the paper that they're printed on, right? Pre-qualification is essentially, we're telling you you are pre-qualified for $500,000 based on the information that you told us on the application. Correct. Okay, how I explain it, I think I try to explain it the simplest is you're pre-qualified on what you've told us. Okay, you are pre-approved based on what you showed us. Okay,
Absolutely.
Pre-qualified on what you told us, pre-approved on what you've showed us. Showed us essentially means you told us you made $50,000 a year. Now you have send up those pay stubs and your W-2s.
Right.
Now you have showed us that you make $50,000 a year. Okay, so you transition from pre-qual to pre-approval. Okay, once you have your pre-approval, once you receive your pre-approval from us, we email it to you. We email it to your agent. And now your agent is willing to take you out and going to go shopping and look for the home that you're looking for. Most agents, I don't want to say agents that are good or bad. In this environment and in most environments, an agent is not going to take you out and look for a home until you have a pre-approval in hand. It's extremely important that you have that pre-approval in hand, and that lends itself to the submission of documents. Okay, there's documents that we're going to ask from you. Okay, they're very, very simple. Well, they range.
I was about to say, depending on your situation, they can be simple. Of course, if it's somebody that all I do is work and save up for a home, your documents.
Excuse me, hold on. We've been, because he might try to. I'm the star of the show. I ain't said that in a while. Star. I'm trying to get it in different spots where he can't chop me out. Star of the show.
We already said I'm Otis. I've already resigned my role to Otis.
I'm sorry. I got. What's that word you use? Digress. I digressed. I digressed. But I'm regressed. What's a regress? I don't even know what a regress is. Is it the?
Hey, for this purpose.
Yeah, but I'm regressed on back. So yeah, go.
All right. So, basically, like as far as going back to the approval versus pre-approval, just like you said, the pre-approval is based on you send in documents, we've gotten those documents pretty much approved through underwriting, and you're pretty much good to go. Now, as far as like the whole agent is concerned, the pre-approval letter itself shows not only the agent but also the seller and their agent that you're serious about buying a home. Like I know a lot of us like to, present company included, like to spend the weekend on Zillow looking at nice looking homes, and maybe some of y'all would actually like to go out, like you might see a for sale sign, so you want to go look at some homes. Window shopping. Window shopping is cool at the mall. Agents really don't want to spend their gas taking you out window shopping for a house.
It ain't no really. They don't want to take you looking out at a house that you cannot afford.
Exactly.
The agent, they're not going to tell you that because, they're going to say it very nicely and put it in a way that they retain your business. But the reality of it is this, and this kind of leads us into what you are approved for and what your monthly budget is.
Exactly.
Right? So oftentimes people call and they say, hey, how much, what am I approved for? You may be approved for $500,000, $600,000 house. But the question that Jimmy and I like to ask, and we pose to you, is how much is your monthly budget? What are you willing to spend on a monthly basis on a home for your mortgage? Okay. Right. Now, you may be approved for $700,000, right? But if your monthly budget is $1,200 a month, there's really no need for you to be looking at $700,000 houses. That's just the truth. And yeah, it's just not going to be $1,200 a month. The way I explain it is, you may be approved to purchase a Range Rover, but you really have a Honda Sonata. Big shout out to Hyundai. Y'all want to sponsor me soon? I'm here. You understand?
I'm saying nothing wrong with Hyundai.
Hold on. Stop. I'm the star. Stop grabbing the mic. Stop grabbing the mic. I'm trying to get this.
Can I at least do the bridge? Like, you got the hook in the verse. Can I do the bridge?
I'm That Brother podcast starting from now. 3, 2, 1. Say, hey, Hans. Let me stop. I've digressed, but I'm regressing.
Regressing that.
After this, I'm going to look up regress so y'all don't think I'm a complete idiot.
I don't think we're using that right at all.
Regress is just absolutely wrong.
Regress is not the opposite of digress. It's not.
I'm smart enough to know that it's not the opposite. I feel like
regress is like when you go backwards. Like when you fall back. Like
you're
doing good, but then you regress.
It's like a tax. Like it's a regressive, progressive tax. Let's just... We
digress. We digress.
Anyway, you may qualify for a Range Rover, but you may only want to spend the Honda Sonata payment every month. Okay, so it's very important. Speaking of which, maybe I get a Range Rover sponsorship. Why did I go to Honda?
Right? You went to Honda. Range Rover.
Listen.
Hey, so depending on who cutting the checks.
Who cutting the checks, right? So you may, it's important that you stay in your comfort zone, right? With your monthly budget, right? So your monthly budget may be that $1,200. That is not going to be a $700,000 house, although you may qualify for a $700,000 house. So I like to present the question back to my clients when they say, well, how much am I approved for? I often ask them, well, what is your monthly budget? What is it that you want to spend? And we kind of back our way. We regress our way. That might work. Right? That might. We regress our way back into the equation. That really might work. But no, seriously. So that's important. Okay. So your approval amount and your budget. Okay. So now we got all the documentation. Mrs. Jones, she has sent us all of our paperwork. And what do we, once we receive all that paperwork, kind of tell them what we're doing with the paperwork and where does it go from us?
So now we take you to see the Wiz. We go down the Yellow Brick Road and take you to see the Wiz, aka the gatekeeper, aka underwriter.
I like go see the Wiz. I'm gonna steal that when you get kicked off the show next week. I'm using that proprietary rights.
So piggybacking off of what you just said about the budget, like what I usually tell people is, I don't want you going out, and this is a good reason why you get pre-approved and you ask all these questions before you even go look for a home. Because I usually tell people, even if we can qualify you for it, I don't want you to go out and fall in love with a $500,000 house and not fall in love with the $500,000 house payment that comes with it.
It comes with it.
So,
what is that cause and effect?
Right. Like this is cool. Like I would love a Lamborghini. On paper, it may say that I can afford a Lamborghini. I don't think I can, as far as like the monthly payment. So that's the same thing. Same thing goes into home buying. And this is one of the main reasons why we're doing this podcast, because I think a lot of people, they say like, okay, well, I'm paying this amount of rent. I could be paying it in a mortgage. And that's the extent of their knowledge. Well, of course, renting a house or the process you go through to get qualified for a rental versus a qualification for buying a home is totally different. So this is the main reason why we're putting this information out. So next step, after we get all your documentation, credit score is good, income docs look good. We got your bank statements, all the necessary documentation that we need. Next step is to go to the underwriter. And they're pretty much the gatekeepers, so to speak, as far as approval versus denial.
They're the judge.
They're judge, jury, and executioner.
And executioner. we're your lawyers. We represent
right. You. And that's a spot on analogy, actually.
I'm spot on. That's why I'm the star. What do you mean? Like,
that is a spot on analogy. Like the underwriters, like you're going to a judge, and it's pretty much like they're gonna not guilty meaning you get the house, or guilty meaning you didn't do enough, or like something was on your credit or something meaning that we need to fix it, and you're not gonna get the house right now. And like you said, like we're pretty much the attorneys that are fighting on your behalf.
We fight on your behalf, submit to the underwriter, and they make a decision. Do they always approve or deny at first submission? So you get everything,
No.
You got everything you want, all the documentation you need from Ms. Jones. Now you go over to the underwriter and you say, here you go. Here's the stuff. Can Ms. Jones get this loan? What happens at that point?
So, and that's great question.
That's why I'm a star. I keep trying to tell you.
Great point. So you may go through underwriting a couple times, like 2 or 3 times. I think our average for people is like 2 to 2.5 times going through underwriting. And the reason for that is when we get you, because you're going to be underwritten off of a couple different items. Like we're going to underwrite you as far as the borrower is concerned and your credit worthiness. And then we're also going to underwrite the property itself.
Can you, what's another word or how would we say underwrite, right? That is like common language for us. Right. So what does it mean when you say we're going to underwrite you? Explain that to someone who's never purchased a home and they're not really familiar with the underwriting terms. What is that? What are we doing to their documents, and what are we doing in terms of like looking at these things? Can you speak to that a little bit?
So underwriting pretty much is, for lack of a better term, like we said, the gatekeeper of approval versus denial, for lack of a better term. So let's kind of flip the script on the client. Let's say the client is lending out money. You're lending out 6 figures, because most houses nowadays are 6 figures.
Right.
You got it to lend, but you still want to get your money back at some point. You're not just giving this out for charity. You're giving it out for an actual loan.
It's funny that you mentioned that, right? And it's not a cutoff. This is, I never thought about flipping it on a client. We flipped it to you when your cousin called you and say, can you cash at me $100? Right. How many questions do you ask your cousin about when you're going to get your $100 back?
Do you just hit submit?
Do you just hit send?
Or do you ask like what it's for?
When they get paid?
When you get paid?
Yeah.
I expect my money. Like, you got questions.
That you are underwriting your cousin's ability to repay you the mortgage.
Add 3 zeros on the end of that.
So,
and then possibly change that 1 to like a 2 or a 3 or a 4 or a 5 or a 6, depending on what house.
Correct. So that your cousins, you're an underwriter. You're the underwriter. You loan money to your family and your sisters and your brothers and your cousins, and you ask them 50 million questions over $20 funky, and you come in here and you trying to get 300, 500, and there's questions that you're going to have to answer and substantiate. That is the most simplest summation. Yeah. Of underwriting. Okay.
Underwriting, there's, of course, like we have, and you'll get into this, like we have conventional loans. You'll probably hear about FHA, like the First Time Home Buyers Program. We also have VA for veterans, USDA loans. So all those loans have different criteria and different guidelines that they have to go by. Different rules, basically, of what we have to show, how we can calculate different things. So that's what the underwriter is going to do. They're going to read those rules, basically. And then they're going to look at the file and see what we have in front of us, and they're going to make sure that we're following the rules based on whatever government rules have been set for the home buying industry.
All right, so everything goes to underwriting. It comes out of underwriting maybe 2 times. Let's just call it 3 for the sake of the conversation.
Well, let's jump back to that. So the reason that it may go through underwriting a couple times.
Because y'all suck. Why y'all asking me for all these papers? Why y'all didn't ask me for this 3 weeks ago? You know you needed this 3 weeks ago. Why you didn't ask me for this 3 weeks ago? My other lender didn't ask me for all of this.
Did you ever want to get your clothes?
No. All right.
Anyway,
back to the matter at hand.
These are real questions. So the reason that you probably heard all these horror stories about like, oh, they ask you for everything under the sun and drop of blood and your firstborn. Yeah, we do, because one,
we're about to lend you a lot of money,
and for two, the reason that we go through underwriting a couple of times is we have a saying: sometimes conditions create more conditions. So let's say, for example, they ask you for a bank statement. Underwriter asks you for a bank statement. You give them the bank statement the first time. Well, there's a deposit in there that they have questions about. So now they're going to ask you, they're going to come back after they've underwritten and after they've cleared off what they need to do and added some more stuff, maybe some more documentation that they need. One of those documents, they're going to ask you for additional documentation on top of your bank statement. Now, they're not asking for a bank statement again. And this is something that we wouldn't have known that we needed outside of you having like a funny looking deposit or something along those lines. So there's different things that could cause underwriting to ask for a different document or an additional document. There are also things that you can turn in that are incomplete. Like let's say, for example, going back to bank statements. If you give us a bank statement and it says page 1 through 7 at the top, but you only give us 1 through 6, but they're going to ask for that bank statement.
But page 7 and 8 was blank. Why do I need to send y'all blank pages? It was blank. It said intentionally left blank.
Because it says 1 through 7, they want to make sure that they have all pages.
Okay, so if the underwriter needs your bank statements and it's a total of 8 pages, they must send all 8 pages.
All 8 pages.
All right.
All 8 pages. No skim. Like, don't just send us don't try to X out your OnlyFans subscriptions. Don't try to just send us 1 page with just the balance. Like, they need all that information. Because going back to if you're the underwriter, you're lending your cousin that $100. Would you accept if you ask them, when do you get paid? When are you going to pay this back? And they say like, next week sometime. Are you going to take that? Or do you want an exact date? Now,
come next week. You looking at your phone like, why? I don't see nothing coming back.
Next week hit, and it's Friday at 5:00. You still looking at your phone? You ain't.
All right,
just saying.
All right, so
this is why.
Got you. So I'm with you there. So everything got a pre-approval. Underwriter, it came out. They're conditionally approved. Now they get. They find a property and they go under contract. Okay? They go under contract. That means they have, in this market, 22 days or so, 20 days or so between the time that they get the contract and the time that they should be closing.
Correct.
I'll talk a little to that point about just being under contract. Being under contract essentially means you have gone binding. Your agent has found a home for you. The seller has agreed to sell you that home. You have signed on a dotted line. And now the clock is really, really ticking because you have 22 days or 20 days to get into your home. Okay, so at that point, it's go time, as we would say. Right. There's if you have any lingering documents that needed to be submitted, you have to get an inspection done. You have to get an appraisal done. There's things that we have to do on our end. But the clock is really, 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 really ticking because now you have your earnest money. You put up your earnest money. Your earnest money is essentially a percentage of the sales amount that says that kind of gives a good faith agreement between you and the seller that tells the seller that you're serious about this purchase. Okay. Exactly. So you have that. You've gone under contract. So there's things that your agent will talk to you about, and we will talk to you about once you've gone under contract to get you to the closing table. Okay. Now, within this time frame, because we cannot approve your loan prior to you having a contract. Okay, you will receive a conditional approval. A conditional approval means you are approved based on the following conditions. Right. Okay, one of those conditions will always be a purchase and sales agreement. You didn't have a purchase and sales agreement prior to finding the house, so we couldn't give you a final approval. So now that we have a final approval, just as you were underwritten and all the details of yourself was kind of checked out and analyzed, now the second part of underwriting is underwriting the property. Okay, again, I talked about the appraisal, making sure that the home is valued at what that the home is valued at what it's being sold for. If you are not if the house doesn't value for what it's being sold for, the bank will only loan on the amount that the house is valued at. Okay, so you're going to have an inspection and you're going to have an appraisal. Both of those things are put in place to protect you and to protect the agreement that you're about to get into.
Correct.
Okay, so from that point, I should say, you're going to, everything aligns, and now you get what's called a clear to close.
Right.
Okay, clear to close means that your loan.
Best 3 letters in the business.
That's the best 3 letters in the business. I have a yacht. In the back of my yacht I don't have a yacht, but Range Rover, holla at me.
We manifesting right now.
Hyundai, holla at me.
Right, we manifesting right now.
My yacht is going to say clear to close on the back. But no, those are the best 3 letters in the business. Your realtor loves to hear those letters. You love to hear those letters, and we love to hear those letters. That basically says your loan has met final approval and you are approved for this loan. So that's one of the greatest days of many people's lives, right? Talk to them and tell them really quickly as we wrap this up on what happens or what to expect once you get your clear to close.
So once you get your clear to close, hopefully like your lender has talked to you about what to expect as far as the final cash to close is concerned, your final number to bring to closing. You won't get the final number until after you get your clear to close. Because what happens is the closing attorney and our closer is going to match up numbers on both ends, make sure that the seller's getting paid what they're supposed to get paid, you're paying what you're supposed to get paid. Everybody that has commissions and the attorney fees, all that stuff is matching on both ends. And that's where your final, what's called cash to close will be. And your cash to close is going to be what you're physically bringing to the table at closing, or what you're physically wiring to the table at closing.
Cash to close is the money you are spending on this transaction.
Yes.
Okay, and it is not, Jimmy said bring to the table because we read that language. You cannot bring cash to the table.
Right. Outside, it'll depend on your closing attorney. 9 times out of 10, your cash to close is going to be an amount that's going to be over what they would allow you to bring to a closing attorney.
Which is typically right around $500 or something. Well, I don't want to say
something like $2,000.
So, really? Okay. I've never seen them that high. But in any case, you would wire the money. We would give you wiring instructions. You wire the money from your bank account to the closing attorney. Right. Okay. So at that point, you had your clear to close. You wired your money. You go to your closing. You get your keys. Everybody's happy. Everybody smiles and takes pictures. Well, sometimes you're happy, but you feel broke because you just sent over all your money. But that's essentially the process from application to clear to close to keys. And we kind of touched on money, and we'll have a conversation at a later episode, just kind of break it down to money.
We're going to spoon feed you.
We're going to spoon feed you. What's that? What you said? The medicine is in the what?
Oh, the cure. The money's not in the cure. It's in the medicine.
The money.
Like if we gave you everything right now, there's no reason for you to watch us.
We gotta set you up for a booster shot. We gotta give him a booster. You
This your first Johnson & Johnson. Hell of a segue.
That's a hell of a segue. God, you might could be a co-star, but that was good. I might need you. I don't know if I need you yet. This is a dry run. After I look this back, I might can cut you off, but you just saved yourself in the 9th inning just now.
So our viewers, I need y'all, like, when y'all come and comment on it, like y'all need to give me some positive feedback because I'm trying to stay on the show.
We don't need them.
If everything is just going to Anthony, then
we don't need him. Let me tell you, the only reason why I got him on the show with me because he got a hairline. I don't have no hairline. I heard it's good for business when you keep a hairline guy around you. It's good. We
get some test runs with some test audiences and the hairline was favorable.
Let me go get a hairline done. And he's out of here.
So here I am.
He's out of here. But no, so we hope that was helpful for you. Again, I'm Anthony Rogerson. This is Jimmy Hicks. Collectively, we are them brothers, and we really appreciate you joining us and us coming, giving you this information. And we hope that you found it useful, and subscribe, follow, and we look forward to share. And
that's
we look
one
forward.
Of the most important things, share.
Yeah, share. It's a button with I don't know how.
That's gonna be all that. We'll have it all figured out. We're gonna have a YouTube channel, so hit the like button,
we got a
share,
YouTube
subscribe. But we don't have a video on it yet.
We're gonna have a video on it.
We have audio. We're gonna be on everywhere: SoundCloud, Spotify, hopefully Apple Music.
Yeah,
so,
but yeah, let us know.
We won't be hard to find.
We won't be hard to find. There's like a rhyme that goes like that, but I don't know that yet. Anyway, I don't want to regress or degress. We just want to say thanks for joining us. We
you
say
want to get into the
what?
pop culture topic?
No, we ain't giving them that right now.
Okay.
We're not giving them that right now.
Medicine versus cure. I got it.
Medicine versus the cure. We them brothers.
We can do that next time.
Peace. See you next episode. Thanks
Later.
for joining us.